Well, there's a handful of things there. Number one, anyone who's looking at getting started in that, I recommend a book by David Green called Long Distance Real Estate Investing. The book is exactly that. Like, how the heck do you buy something on the other side of the country and manage it? Because good management will make or break your investment. In terms of us, Vantage Point, my philosophy is live where you love to live and invest where you get the best returns.
Hi, Adam Gower here, founder of gowercrowd.com and host of the Real Estate Reality Show at youtube.com/gowercrowd and on good podcasts everywhere. Welcome to today's episode. My guest today is Andrew Cushman, who is founder and principal at Vantage Point Acquisitions. Now, I've been trying to get hold of Andrew for quite a while. I first came across him on LinkedIn, where he posts apparently a couple times a week and always get some pretty high engagement. And I actually quote him occasionally in my weekly newsletter, which, segueing in, if you've not already subscribed to, please go ahead to gowercrowd.com. Make sure you subscribe to it. It comes out every week. It's totally free. You can always unsubscribe. It's packed with information. Not only that, there's going to be stuff coming out over the next few weeks that will blow your mind. OMG, we've got some cool stuff coming. Andrew and I ended up talking about, so my first agenda item was, all right, how do you post? What do you post? Why do you post? Do you write it? Use AI, etc., etc. But we ended up talking about commercial real estate because Andrew has some really interesting insights into how to manage projects, multifamily projects from across the country. He has been very successful in living in California, but investing in deals all the way, it seems, in the Southeast on the other side of the country. So I wanted to know how he did that. It's been a major barrier, really, for many of the new sponsors that have come into the market in the last few years. But Andrew seems to have dialed it in, and you're going to learn from him today how he does it, what is his secret to success. Then, as we get towards the end of our conversation, I couldn't resist. I did ask him how he decides what to post on LinkedIn, how he writes it, how often he writes, and if he's seen any patterns that help determine whether or not something is going to be a standout, highly engaged post or not. You can hear all about how he does that right at the end of our conversation. But for now, let's get on with it. Andrew Cushman, founder and principal at Vantage Point Acquisitions. Here he is. Andrew, it's been a while. Thanks so much for joining me. I've been wanting to talk to you for ages. I keep seeing you on LinkedIn in my feed. As I mentioned, I do quote you and put your charts and commentary in my newsletter. It's very insightful. So we talked about what we're going to talk about. You know, it's like one of those, we've got to have an agenda to decide what the agenda is going to be.
Pre-meeting
Before,
meeting.
what's that?
A pre-meeting meeting.
A pre-meeting. Exactly. So how should we approach this? I'll tell you what, let me start with this. Why don't you tell me? It's interesting, actually, that you just told me that you're in Southern California. Oh, my goodness. But all of your assets are in the Southeast. So why don't we start with that? That has been one of the biggest challenges that a lot of new sponsors to the industry have had, is remote management of assets many states away, right? So tell me about your approach. How do you deal with that? What's your story over there at Vantage Point? And how do you manage? Why are you looking all the way on the other side of the country, living in lovely Southern California?
All right. Well, there's a handful of things there. Number one, anyone who's looking at getting started in that, I recommend a book by David Green called Long Distance Real Estate Investing. The book is exactly that. Like, how the heck do you buy something on the other side of the country and manage it? Because good management will make or break your investment. In terms of us, Vantage Point, my philosophy is live where you love to live and invest where you get the best returns. So Southern California, I like to surf. I like to snow ski. I've literally done both on the same day, and stopped at home for lunch. Right, so it wasn't even like this like crazy thing. It's just like, yeah, go surfing in the morning, have lunch at home, and go snow skiing in the afternoon. and the weather's perfect. It's like 363 days a year. So I love to live here. However, all the horror stories that the rest of the country thinks about California are true. It is not business friendly. It's got, there's a lot of what I would call, let's just say, legislative risk. Rent control, 2 years of eviction moratorium in LA County. I mean, I had real estate investor friends who had people, essentially legally squatting in their portfolio for 2 years, not paying rent, knowing that it was temporarily illegal for them to be evicted. So
Yeah,
we're
not
certain.
only that, you still can't increase rents. It's just
Yeah, and
by.
yeah, exactly. And by the way, when your insurance doubles and your property taxes double, and good news, you can raise rent 3%, right? Doesn't work. Now, lots of people have made lots of money in California real estate over the years, just not my cup of tea. So that is why we chose the Southeast, because number one, a lot of reasons. One, they're business friendly. They are landlord friendly. Generally, it's a moderate, like weather-wise, climate. So you have 4 seasons. We're not dealing with massive snow removal. All the things you get in some of the other parts of the country. We don't have earthquakes out there, and also affordability tends to be pretty good. You have a large chunk of the population that can afford mid-level rents. And even more importantly is you have those states tend to have above average population growth and job growth. And if you want to boil it down to the one factor that determines the success of a long-term rental, it's buying in an area where you have increasing population, income, and jobs. So that is why we chose the Southeast. I don't want to, I shouldn't say I don't want to live there. There's nothing wrong with living there. I just love living out here. So then the question became, oh, well, how do we do both?
Mhm.
And so what we did is again, years ago, we spent a lot of time and very intentionally chose and partnered with a third-party property management company. And then we do, so you'll talk to some investors, they manage all their own stuff. Then you talk to others who, well, I do third party. We do a hybrid. We use the third party for all the day-to-day like admin stuff, like signing leases, touring units, taking care of the lady in 3C whose dog bit the guy in 5B, all that kind of day-to-day headache stuff that comes with owning rentals. And then they take care of that, and then we very closely have integrated ourselves into the operations and the management. So we really kind of do a hybrid, and that's how we've been able to successfully manage these assets from the other side of the country. And we've been doing that for 13, 14 years now. So
So it's you use the term partnered
mhm.
with one of our clients is actually an industrial shop, and they literally partner with their local managers, and they invest. The manager invests in the deals, and they have a vested interest. So when you say partnered, how do you partner with managers?
What you just described is something that I would say is an industry best practice. Not something that many people do,
Hmm.
but it's a best practice, and that's exactly it. So when I say partner, part of it is because we've literally been working with the same company for 13 years now, and so it very much feels like a partnership. They treat us like a partner. I still, I can call the owners of the company on their cell phones, right? Um, However, part of it does come down to financial incentives. So they get paid based on, the performance of the property. The higher the revenue, the more they get paid. But also, they get paid with a bonus based on the net operating income. So our philosophy is,
Hmm.
you know, if somebody's making us a lot of money, they should benefit from that too. And so when we buy an asset, we sit down with everybody on the management side and say, look, here's our business plan for this. Here's our thesis. This is post closing. And here's what we need to produce profit wise, cash flow wise from this property to meet or exceed the expectations of our investors based on what we told them we can think can happen. So that's the minimum, is to hit that. But then what we say is, okay, every dollar above that
Mhm.
you get a percentage of it with no limit. So we have property managers that their bonuses, can be 30, 40, 50% of their base salary because they are making those properties perform so well. So their interests are aligned with ours and are aligned with our investors. And so I think that's a real critical component of making it more of a partnership versus just a hired hand that doesn't really care that much about the property.
It's interesting you say that. It sounds very similar to hospitality, where a hotel's GM will be compensated in part based on how they perform against Star Report, Comset, performance, etc. So how has that been working, Andrew, in the last few years and we'll start talking about some of your LinkedIn posts, where insurance rates have gone up, cap rates are going up, values are coming down, mortgage rates are going, so that NOI presumably is being squeezed. How is that? Just talk to me about how that has impacted what you guys are doing there with your managers.
It's had some impact, but really, we're fortunate the impact hasn't been that bad. And candidly, I think part of it fear sells. So, things aren't actually as bad as the headlines, say they are. Now, with that said, I do know people who've had their insurance literally double overnight. The worst we've seen is on our Florida Panhandle properties. Our insurance renewal went up, I think 60 or 67% a year or two ago. And so that is a pretty big hit. However, those properties were performing so far ahead of expectations to begin with that even with our insurance going up 60%, we're still way ahead of pro forma. So, do I like to see the insurance go up 60%? No. Did it change anything? No, it actually didn't. We had such thick margins that we didn't change distributions. We didn't change really anything because the properties were doing so well to begin with. So, you know, though, now if you've got a property that's highly leveraged and it isn't performing that well and insurance goes up 60%, could that be a problem? Yeah, absolutely. Um, but again, those are properties where the managers are on that incentive program. They're in submarkets that are seeing very high population growth, very high, strong job growth. And so getting back to managing things from a distance, that's part of how you set yourself up for success, is choosing markets where you have very strong tailwinds. Because when something goes wrong, not if, when something goes wrong and your insurance is twice what you projected, that's going to hit you. But hopefully enough other things have gone in your favor that it still balances out. So and on a better note, I literally got an email from our insurance broker this morning who he gave us an update, and he said that our for our upcoming renewals, the carrier lowered our rate. So, insurance cycles just like everything else. So there's a ray of hope on the insurance side.
So you commented recently about the relationship between cap rates and the 10-year treasury.
Hmm.
Yeah, so talk about that because I mean clearly there's downward pressure on values. So how does that affect what is the relationship with the 10-year treasury for one person that doesn't really understand that connection? And how have interest rates been impacting you and cap rates, valuations, etc.?
All right, so there's a few questions there, so just repeat if I forget one. Um, the
Sorry, I shouldn't ask so many. It's like a triple barrel question.
Yeah, I'm like, I'm gonna forget at least one of these.
Yeah.
So the biggest way that interest rates have impacted us is we have not been able to buy anything in over a year now, because when we do our underwriting and we put today's current cost of debt in there at today's current interest rates, the price that we have to offer, sellers aren't yet willing to accept. So there's been a significant spread in what sellers are asking and what buyers are bidding. And that's not just us. I know a lot of operators who haven't been able to buy either. So that's frustrating. That's the biggest impact, is just we haven't been able to get, because of interest rates, we're having to lower our offers and sellers haven't yet been willing to accept. And so we haven't been able to buy or acquire properties at a price and structure that we feel is appropriate and safe to bring to our investors. That's the biggest impact.
Andrew, are they selling though? These deals that you're trying to underwrite, but not getting there? Like
That
who's are they selling and who's buying?
So okay, so that's a really, good question. Sometimes they are, sometimes they aren't. So a couple of them have sold, and it's gone to people that either we think they overpaid or maybe they have a much lower cost of capital. So I'll give you an example.
Mm.
I know another operator who the majority of their capital comes from certain countries overseas, and they don't care about earning a return. They just want a safe place to stick their money where the government won't take it and where they won't lose it. So if as long as they break even, they're happy. If they make 3 or 4 or 5%, that's just icing on top of the cake. I can't compete with that, right? So sometimes we lose out to stuff like that. But to your point, several of the deals that we got close to recently, the seller just said, we're just going to try to hang on, right? They're not gonna sell. Now, how much longer they can hang on, that's another question, right? The deals are building up like water behind a dam. They're gonna release eventually.
Mm.
It's just continuing to build up,
That's
and
an
so
interesting point. Actually, let's talk about that. So, what's going to cause that dam to burst, do you think?
it's gonna be it's like any it's a number of factors. Number one is life still happens, right? People get old and want to retire, divorce, sickness, death, all those things, and those things happen, and people just sell, right? Also, and again, this is speaking more to the smaller property, more mom and pop operator side of things, but also just tired landlords. It's been the previous 10 years have been a great time to be a landlord. I guess that rents are going up 5% every year, right? Rents aren't automatically going up anymore. Operations are gotten way more difficult because people are having trouble paying, expenses are going up. It's not that it's been getting more challenging to evict people who don't pay. So being a landlord has been much more difficult the last 2 years than it was the 10 previous. It used to be fairly easy. Now it's a real job like it used to be. And that wears people out. Like, oh, wait a second. All these podcasts telling me this is passive income. This is like the least passive thing out there. Right. So that happens. And then on a kind of bigger macro level, um, as time goes on, number one, I'll say three things, and I'll probably forget the third one by the time I get there. The number one is, people like for syndicators, for example, when I typically buy on a 5 or 6 year timeline. Well, those timelines come up and the investors are like, well, hey, are we going to sell or not? Right. So there's some pressure there to sell. Number two is a lot of something like 70% of multifamily was purchased with floating rate debt in
Right.
like 2021 and 2022.
Yeah.
Those are typically 3 year terms. Well, those loans are coming due and the values are down, interest rates are up. They cannot refinance. Many of them can't even sell because the property's worth less than the loan balance. Now, so a lot of those have been extended 6 months or 12 months. That's why you haven't seen a lot of deals yet. But eventually, once the banks realize, oh, this problem isn't going to go away, they start saying, you know what, we're not going to extend that. And so loan maturities will force a lot of sales and transactions. And then the third thing that I would say, and there's more, but these are the top three that kind of come to mind, is these buildings are expensive to maintain. You can't, you don't just buy an apartment complex or a fourplex and say, okay, I'm going to sit on it for 30 years and not put any money into it if you want that property to not become a slum. Roofs age and need to be replaced. Appliances these days seem to only last like 5 years, and now it costs 3 times as much to replace appliances as it did 5 years ago. You've got, landscaping dies, siding needs to be redone, windows have got to be replaced. These properties take a lot of money to maintain, and that's one of the reasons a lot of operators you'll see will sell every 3 to 5 years is because they buy a property, they spend some money fixing it up, and most of that stuff lasts between 5 and 7 years before it needs to be done again. And so as these timelines extend beyond what people planned for, they're not going to have the money to keep up with the physical needs of the asset, and that will add to. Now that's more of a little bit longer term thing,
Mm.
but those are three that come to mind right away as some of the things that are gonna lead to it. And again, if interest rates stay as high as they are, I think it's gonna today it's gonna push more. It's gonna force more sellers to the table. And then also here's your bonus fourth one, right? At the beginning of the year, hope was high. There's lots of optimism. Oh, 2024 rates are coming down. The Fed's going to save us. Everything's going to be fine. As that hope evaporates, and most people are now thinking, oh, wait a second, we might be here for a long time. Rates might even be higher in the near future. Then the internal conversation becomes, wait, do I really want to try to hang on to this for another 3 or 4 years? Forget it. Like, okay, bank, here's the keys. All right, so.
Well, we'll see. It's funny because I had this same conversation with James Eng of All
Yeah,
Capital in
I know
Texas
James.
in I don't know, September last year, and we were pointing at first and second quarter 24 as being the time when everything would shake loose, but it still hasn't. And it certainly seems like the banks are significantly more willing to work with borrowers than they were during the global financial crisis. It's probably got a lot to do with it.
Well, and that's a good point. That is part of it. The banks are being a little more flexible. Again, I think that's going to eventually kind of come to an end. But if you go back, the global financial crisis started in 2007. There weren't a lot of readily available deals until I'd say maybe 2010 or 11. Like that's when the buying opportunities were like shooting fish in a barrel. And to me, it kind of feels like 2009, where volume's still really low, but pressure's building, and
Mm.
eventually, it's just a normal market cycle.
Mm.
Volume dries up for a couple of years, and then it becomes a little bit more political. And a lot of buyers are leaving the market. I know a lot that have just moved on to other stuff.
Gone back to selling encyclopedias.
Yeah, well, I know one in particular. They just said they literally sent out a newsletter and said we're done with multifamily. We're now doing oil and gas.
Oh, right. Okay. Good. Um, all right. Good luck. Right. You've chased tax benefits. It's like going out to save money by spending money somehow. You've still got to make sure the thing works. Anyway, so I don't know anything at all about that example. But what size deals do you invest in, Andrew? You mentioned fourplexes and whatever. So what kind of range of size deals you look at?
Yeah, for us, generally speaking, the absolute smallest we'll look at is 80 units, and we prefer to be between 80 and 250 units. The biggest we've done is we bought one that was 348, and a 350 unit apartment complex, that's more like trying to turn the direction of the Titanic versus a clipper ship. It's a slow moving process, and the reason for that size range is, and part of it gets back to how do you manage from the other side of the country, is when you're at 80 units and above, that size economically supports full-time on-site employees, right? So once you're at 80 to 100 units, you can hire a full-time property manager and a full-time maintenance person that is their job. They stay, and often, many times, they will live at the property. And then the reason we don't prefer too much above 250 is, again, it just kind of feels like it's just so big that it's kind of you're not that nimble. And also we've found, and part of this might just be like, where we're operating and our size and all that, is there seems to be a kind of a sweet points, or peaks in efficiency at like 120 units and at like 220 units.
Hmm.
And when you get further away from those, the properties don't run quite as economically efficiently. And so we really like those 2 points of like 120 and 220.
That's interesting. So, what are those intersections? As you say, kind of optimal efficiency. I
Mhm.
immediately spin back to economics at high school and think about supply and demand and the kind of how you calculate those crossover points. So what is causing that optimal performance at two interestingly and quite different levels, 120 and 220?
So basically, it really comes down to kind of essentially your fixed costs and how you're spreading those out. So let's just say 80 units versus 120 units. A kind of a general rule of thumb in multifamily is that for every 100 units, you have one person in the office, which is a manager, right? And one person outside, which is your maintenance, out running around fixing stuff. And basically you're gonna the salary you're gonna pay to hire those people is dictated by the market, right? It's not, so let's just say you're gonna hire a property manager for, I don't know, $60,000 a year, which might be a little bit low these days, but call it $60,000 a year. And then you're going to hire a maintenance person for $60,000 a year. So now you have $120,000 in wages.
Mhm.
Take that $120,000 in wages and buy an 80 unit property that now has to cover those wages, or buy a 120 unit property that has to cover those wages. It's going to be the same amount of people. You're not going to hire an extra person for 120. So now you're taking that $120,000 wage burden and spreading it out over a greater amount of units, but you're collecting a lot more revenue and you have a lot more cash flow. So it becomes more efficient. Also, you don't want people sitting around with nothing to do, right? You don't want to probably don't want to hire full-time people to manage 30 units. That's not really a full-time job. Now, on the flip side, you can't overwork people. So let's say you buy something that's 150 units, that's too much for one, generally speaking, that's too much for one maintenance person and one manager. So now you got to hire more people, but you've only got an extra 30 units to support that. So your efficiency dips when you get to like 200 or 220. Once again, you're at a node where you got, either way, you got to hire that second person, but now you've got more revenue to pay for it. Right. And there's also some efficiencies with contractors and expenses and all of that. But that's kind of the idea. You have certain fixed costs that you're spreading over more units, but you can only spread them so far before you get too thin.
Let me change direction a little bit as we start to wrap up. So, so as I mentioned, we build crowdfunding platforms. It's
Hmm.
actually not the right term. Help syndicators raise capital online. That's our business. By developing websites and content and social media and communications, essentially, and then we help them navigate through the investor journey until they convert prospects into being investors. So, a couple of questions for you. So, I went to your website. So this is VPACQ, Vantage Point Acquisitions, ACQ being the ACQ,
Hmm.
being acquisitions.com. And you got a nice button here on the homepage that says join our investor list. Beautiful. It looks like the Amazon orange. I don't know if you thought of it that way, but that's a great way to go. Basically, if in doubt about colors, go to Amazon and mimic theirs. It's my
That's a wise piece of advice. I can't take credit for that. That's another one of my team members who
Well,
did that. Yeah.
it's a good thing to do because you got to figure that they've got some good data that kind of encourages people to click. Depends what you want them to click on. But then you go to a page here that actually has quite a lengthy questionnaire and also requires that people speak to you. So how has that worked for you? I mean, do you get a lot of applications through that, or is it just something that you put up there some time ago and kind of forgotten because no one ever comes through it? How does
Oh
it work?
no, 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 no. That's very intentional and very active. So obviously we syndicate our deals, which means unfortunately it's not Andrew Cushman personally buying a 200 unit property. We have investors that provide the majority of the equity or the capital to do that. So every deal we've ever done, except for one, has been under Regulation 506B from the
Really?
SEC, which
Ah,
which means
requires it.
there's
Yeah.
no solicitation. You will not hear about our deal. I do not post them on LinkedIn. I do not talk about them on podcasts. There is no public mention of our investment opportunities at all. The only way you find out about them is by being on our list, our potential investor list. And part of getting on that list is number one, completing that quick form. It's basically like, hey, name, contact information. Are you accredited? Are you not?
Mhm.
Etc. And then that gets submitted, and then yeah, we do a 15-minute interview with either myself or another team member to verify that, number one, that we're a good fit for each other, because we don't actually accept everybody. And then number two, part of it is the SEC rules require that there be a pre-existing
Right.
relationship. And so if we say, well, look, this we had they completed a form, and we have notes from our phone conversation, and here's the date and the time that that happened, that clearly establishes some pre-existing
Right.
relationship.
So pre-existing relationship is one thing. Let me ask you about this and how that's defined. Why do you not go with five or six C's then and just have a give me a name and email address?
A couple, well, and not to say we never will.
Mm.
But the reason we haven't is in our history so far, every deal we've ever gone to fund has quickly sold out. So we have never needed to solicit or actively go out and advertise for investors. Second of all, a lot of our very early investors, the people who bet on us when we were, fresh and new and pretty unknown 10, 12, 13 years ago, are sophisticated. They're not accredited. And if we do 506C, which is accredited only, it excludes them. Now, granted, they're actually at this point a very small percentage. The 85% of our investor base is accredited, but we still try not to exclude the people who helped us get going, a decade ago. So we still do 506B. Again, I'm not. If eventually will we do 506C? Yeah, I could see that happening, but so far just haven't needed to. Also, there's an additional burden of going 506C. You have to verify accreditation. Right now, Adam, you could be like, hey, Andrew, I'm accredited. And I'm like, okay, cool. Put that on your form. You're good to go,
Right.
because we're doing 506B. Once you go C, I'd be like, great. Send me either a CPA letter or tax returns, or go to Verify Invest, and
Right.
have, yeah. So there's additional rules. So.
There is. Just as an FYI, and we just get bogged down. It's not a big deal.
Right.
We
Yeah.
yeah, we run with a lot of clients that it's like a whatever. It's small admin thing. It doesn't really make certainly doesn't create friction. People don't not invest because they got to prove it.
Oh yeah. I mean,
Is
the
that a double
majority of
negative? Don't not, but
Yeah, well, and you're right. I mean, the majority of sponsors do 506C. Again,
yeah,
we've just never
yeah.
needed to.
All right, cool. LinkedIn posting. I know you're very humble about it. I asked you, so you're pretty. I don't know how often. I mean, relatively frequently. You get some good interaction. It's what inspires you to post something on LinkedIn? And have you noticed any trends that when you post something, a chart or a picture, there's this cool thing of Walmart? It did, these Walmart shoppers fighting over, a sale thing you talked about, buyers chasing multifamily. And
Hmm.
have you noticed any patterns? Like, do you write these things yourself? Do you think you concoct the ideas? Do you use any tools like any AI tools to help you write? And like fess up. How do you do
No,
it?
it is 100% just me. I write it. I don't use AI to write stuff. Um, I generally post about twice a week. I have not figured out exactly what determines like a post that I think I'm like, oh yeah, this will probably get a lot of interest and be engaging, and it's like crickets. And then something that I'm like, all right, yeah, okay, let's talk about this, and like all of a sudden 60,000 people have seen it. And I'm like, what in the world is going on? So, it seems like stuff that speaks to uh high profile things in the market, like our value, cap rates and interest rates are too close, and that means either rates are going down or prices are going down, right? Like that got a lot of engagement, because that's important to everybody, and it's a big question. But sometimes something silly like, hey, we found a resident that was putting lawn chairs on the roof of their unit. It also gets a lot, because I think it's because people, almost no one talks about the headaches of and realities of owning these properties and managing them. And I like to post like, like, hey, here's the crap we went through today.
Yeah.
That seems to get some good engagement too. And it's
Yeah, the
just,
firefighter story, that was kind of
oh, yeah,
bizarre. Just
yeah,
tell us
exactly.
that, because that's kind of a cool one as we wrap up, and then we'll sign off. The
Yeah. So
firefighter story.
all that was, and this is what made me post. I'm like, okay, I've gone through this so many times. I cannot be the only one. So we had a small apartment fire where someone left a vent, of a bathroom vent on. They left. It kept running. It eventually shorted out and caused a small fire. They came home right there, got a fire extinguisher, put it out, right? Okay, fine. But just to be safe, they called the fire department. Fire department comes in, and I have friends who are firefighters. They've told me 98% of their day is really boring. It's just sitting around waiting for stuff to happen, going to elderly, homes and stuff like that. Very rare are they like really doing fires. And thankfully they're there when we need them, but most, so what happens is these guys show up, they take their axes, rip down the ceiling, and then then they got to tear down walls in other rooms just to make sure fire hasn't spread. And it's like, okay, I guess I kind of get it being, extra safe. All right, fine. It seems pretty clear this thing's out. Then, now that they've got the ceiling torn down, they see a drip of water coming from somewhere. And so they decided, well, hey, we got to figure out where this water is coming from. I don't understand how that's related to the fire, but they did. So in the process of tearing through more walls to find that, one of their axes sliced through a sprinkler line, which then flooded that unit and the two units below it. And so when our property manager gets there at 2 o'clock in the morning, they're all standing out in the parking lot, and our manager shows up, and the firefighter laughs and goes, "Oh, you're gonna love this one." Right. So it's gonna, again, and it's not, and we very much appreciate our first responders because there are definitely times where they got something put out and it was only one unit instead of an entire building. Right. But at the same time, I mean, many times we've had situations where something that was a very small manageable incident because of the firefighters turned into $10,000-$20,000 in damage when it would have been 500. And so I just posted that story. I was like, hey, this is what seems to keep happening to us. It's like, am I the only one? Like it's like 90% of the damage is done by the firefighters and not what they were called for, so yeah,
Well, they're
I just
probably reading your LinkedIn posts and thinking, oh, it's that guy again, bloody bad mouthing us. Let's give him another run for his money.
no,
Prove
I
his
mean, again,
story's true.
we certainly appreciate, and again, I mean, I would
Well,
much
of
rather
course.
that than a whole building burn down
Yeah,
or
yeah.
someone get hurt. But
Hmm.
still, it's like, can we be a little more conservative with destroying stuff, please?
Yeah, I actually bought a property that had been had a fire, a serious fire, but an enormous amount of the damage that was actually caused, and it was derelict and was going to be demolished by the city. So we actually came in and renovated. I was like ground up stuff, basically total renovate. Took it down to the studs. A lot of the damage was actually water damage
Hmm.
from the efforts putting this thing out. I mean, it had been sitting there for years. It was a whole story. But I did realize that actually water, that's when I learned many years ago that water is as damaging, if not more so, even than fire
Oh yeah.
in a building. Andrew Cushman, thank you so much for joining me, founder and principal of Vantage Point Acquisitions. What a pleasure seeing you today. I know you said you were a little bit sleepy, but you would never know it from our conversation today. Thanks so much for joining me.
I enjoyed speaking with you. Have a good talking with you.
Well, that was Andrew Cushman, founder and principal at Vantage Point Acquisitions. Interesting guy, right? And yes, actually, what I found particularly interesting was how I'm not sure if he consciously did it this way, but how he actually structures his property management compensation structure is very similar to the way that that hotels do it with their general managers. It seems to have worked. It certainly works for hospitality. They've been doing it for years. So it's interesting that he's applied it, and it certainly seems to be working for him as well. Remote managing deals all the way on the other side of the continent. Andrew, thank you for joining me. What a pleasure. I will add you to my newsletter list if you're not already on it. Thanks for letting me do that. And dear viewer, if you've also should say dear viewers, plural, not singular, shouldn't I? But if you've not already subscribed to our newsletter, go ahead to gowercrowd.com. You'll find a big red button there somewhere that says subscribe. It's totally free. And actually, if you click on it, there's a list of all the companies for which, not all of them, but a good selection of all the companies for which our subscribers work. It is blew me away when I first saw it. So go ahead, take a look at that, sign up if you're not already on the list, and start getting our newsletter. All right, that's it. Andrew, again, thank you so much for joining me. Dear viewers, thank you for joining me. And for this week, this is Adam Gower signing off.